A very good afternoon, everyone. We are ready to start, and welcome to this webinar, our last webinar for the series, the financial year 2023-2024. We have our panelists with us. Monica is joining in. She's logging in. She's finishing up. I would like to start by invitation of Kenya Insurance of the live. Introduce yourself. Let us know you. Put on your camera and unmute yourself. Introduce yourself, Pauline, briefly.
Oh, good afternoon, and thank you very much, Noella, and good afternoon to all the people who've joined the forum. My name is Pauline Gadhuri, Association of Kenya Insurers. Thank you.
Thank you, Pauline. Mr. Kiama, kindly, if you'd also introduce yourself. There you go.
Good afternoon. My name is Kiama William from Aki. I'm in charge of the General Insurance Department at Aki.
Thank you, Mr. Kiama. I would also like to recognize the presence of Hazel Kingori on this call. We have put together this webinar with Hazel. Hazel, if you're online and you'd like to say jambo, this is the moment.
Good afternoon, everybody, and welcome to this webinar. We hope that you will leave with some nuggets of information, something new that you will learn about insurance.
Thank you, Hazel. And I like the way you have started us off, that we will leave with nuggets of information and that people are going to go away with something. And that starts us off right in the statement. You know, there is this common saying that insurance is not sold. Insurance is bought. Insurance is purchased. I'm sure you've come across that quite a lot of times. And to you, Pauline, just in brief, I mean, as a starting, really, you talked about you heading the life business, life section at Aki. What is that all about? What is life? What is long-term business? And what makes it be called that? Thank you, Pauline.
Thank you so much. So number one, Noella, if I may just start with your opening statement. I don't think that statement should hold water anymore, that insurance is sold, not bought. What we should build, once a client understands the need, then they actually buy the insurance and they appreciate what they bought. So in short, very briefly, life insurance is basically a contract between a policyholder and an insurer. And the policyholder then pays the premium, and the insurer promises to pay a designated beneficiary a sum of money upon the occurrence of the insured event. For example, depending on the contract, the insured event could be a terminal illness, critical illness, or death. And that can trigger the payment of the promised amount of money. So the core of life insurance is to help one plan. It's a plan for life. For example, one can plan the most common that we know, the education of the children, so that this remains protected despite what could happen to the parents, maybe loss of income due to illness, due to critical illness, or due to death. So basically, life insurance comprises, why we call it long-term is because the policies run for a long period of time, not a one-year period. And we have various products depending on the need of the customers. So I don't know why, whether Noella, you want me to go into the products, but basically just think of life insurance as a financial plan for the family, where somebody can plan for their lives, their family, and major milestones in life.
Thank you, Pauline. And I liked how you put me back in my place. That statement shall not hold water anymore. And I think that is really good news to know that we no longer would say that insurance is pushed from the demand side rather than from the supplier side, rather than the demand side. And would we say then, from where you speak, where you sit, Pauline, is that growth? Is that development that now actually we're talking about you looking at your needs, identifying them, and reaching out? Is that growth? Is that a place that should we be clapping ourselves on the back that we've achieved, we've gotten to that level, Pauline?
I don't think we have arrived to the level that we would want, because we would want everybody who buys insurance understands what they buy and sees the great benefits that insurance offers. And so they buy it fully knowing this is why I'm buying this, and get committed to keeping their policies in place, read the policy document, have an understanding of the benefits and their obligations. We are not yet there, Noella, and I believe that is also part of the purposes of the objectives of this webinar. And as we continue creating awareness in customers, then we achieve that. But I think we've made quite some good strides from where we were maybe 3 years back.
Thank you. I would like to bring on call William. William heads the general business department at AKI. And just tell us, what does that really mean? You're talking about general business. What is that, William?
Maybe just for those who are not, who may not be very conversant with insurance, it's actually divided into two parts. That is, we have general insurance and we also have the life insurance, as Pauline has stated. So the general insurance is basically covers the various risks in that we encounter. It's basically what I would call the ordinary risks excluding life, the ordinary risks that we face excluding life. So is normally regarded as a short-term insurance because these contracts will normally run for a period of 1 year. There are several cases that you'll find contracts running for maybe beyond a year, but those are special cases. So generally, the general insurance will run for a period of 1 year, and that's why they are referred to as short-term insurance.
Thank you. And which type of short term, now that you're on the floor, which type of short term is, I mean, the common ones that you'd easily speak about, Mr. Kiama, the ones that on average, everybody is almost coming to in touch with on a daily basis?
We can speak of maybe like medical insurance that will cover you against any kind of illness that you encounter. You can also talk about a personal accident. This is a policy that will cover you against any accidents. Wherever you are, it's a 24 hours cover. So as you go out there doing your daily activities, you may be hurt or you may get injured, and then that policy will cover you against that risk. So we also have what we call like policies like domestic package. Everybody where you are living, even if you do not own the house, then you have the property that you have in your house, the mobile phone that we walk around with, and all the other items in the house covered under a policy that is known as a domestic package. And I think that is a cover that everybody needs. It's not an expensive kind of cover. It's basically with around some like 3,000 Kenya shillings, you are able to get yourself a policy. Likewise, the personal accident policy. the premiums are quite low. It's like something like 1,000 and you have your cover. So depending on the level of cover that you'd want to take, then that determines the amount of premium that you pay. But generally, it is not an expensive type of cover.
Thank you, William. Pauline, maybe you can expound on the types of life insurance covers that are available and what makes them different from one another. Thank you.
Okay, thank you so much. Yes, for life insurance, the main products we have, they are geared towards somebody's needs. It depends on what stage somebody is in life. So basically, if I may just group them for the purposes of our listeners, we have individual life products. These are the personal lines of businesses that somebody can purchase as an individual. So we have various types depending on the need. It depends on the stage you are in life. For example, for a young person, the basic need could be an investment product to create wealth and to secure their future. For somebody with a family, they could be thinking of a product that protects, enables them either to take up a mortgage, buy a house, and also a product for the children's education. For somebody who is maybe now has already educated their children, they could also be thinking about maybe retirement. So at the very basic level, for personal lines of business, for life insurance, we have the term assurance. And this is the cheapest form of insurance. And the term assurance basically gives you protection, the policyholder, for a limited period of time. And it doesn't contain, it does not cover any investments. It's just the protection against death. So that is why it is very cheap. And a full sum assured that has been agreed between the insurance company and the policyholder is payable when the person passes away. And then another product which is very popular, and it also depends on the needs that somebody has, is the endowment. And this is the most popular product in Kenya. So it combines both protection against death, against critical illness, against permanent disability, depending on which insurer you're buying from. And it also has an investment portion, such that if maybe it's for a 10-year period, the most common period is maybe 10 years, so that if it's for a 10-year period, then if the person does not thankfully pass away or have any illness, then they are paid a maturity. So it both serves as an investment and for protection. And the endowment is the main product that people buy for education. So it's also, when you hear of an education policy, it runs on an endowment policy, where the person can, even for education, you actually plan when you want the benefits paid, and you coincide those benefits payments with when the children, when your child is maybe going to Form 1, Form 2, Form 3 for 4 years, and maybe another 4 years for university. So it helps you plan how you want the installments to be paid. Then the next class under individual life is the pure investment product. This one, whatever money, it gives very little life protection, but it's mainly an investment product, and most of the time we call them unit linked. The last product under individual that I would like to just mention a little, Noera, with your permission, is what we call the last expense product. It's mainly a term assurance, but I want to dwell on it because I believe that every Kenyan, if they understood this product, would buy it. And the premiums are very, very cheap. With 1,000 bob, somebody can be able to purchase a last expense cover of 100,000. And the way the product runs, it's also very, very easy, very simple to understand. And what I always say is the culture we have in Kenya, immediately if a friend calls you, they've lost someone, the immediate thing you'll do is get onto your phone and send them 2,000 bob, to cater for their funeral expenses. But with 2,000 bob, that can purchase a life cover for last expense worth 200,000. So if we are able to change the culture among our circles, maybe the chamas we belong to, maybe in the employment where we belong in our jobs, in our churches, and just tell people that you can actually, as a group, purchase the funeral cover or the last expense cover for a group of people, then it becomes very easy, because with a premium of about 2,000 per year or 2,500 per annum, you can actually purchase a sum assured that becomes payable 48 hours after death of about 200,000 Kenya shillings. And that makes a lot of sense. And I think as a country, we really need to, change our culture so that we are able to embrace insurance. And there are so many people going through a lot of difficult times when they really need to, when they've lost a relative, and this would really come in to help them. Just briefly, the chair, the other two products we have are mainly the group schemes. Group schemes can either be organized by the employer for the benefit of the employees, and all employees are covered under the group life cover, which is an annual cover. And in case of death of any employee, then the sum assured, which is basically a multiple of the salary, maybe 3 years salary or 5 year salary, becomes payable to the beneficiary. And we also have the loan protection covers, which are also group schemes. And these are basically organized by the financial organization. Like if you have a mortgage, then you'll be required to take the loan protection, so that in case of death of the person who has taken the mortgage, the insurance company comes in and pays the entire outstanding mortgage loan. And then the family, the house passes free of charge to the family that is left. So basically, those are briefly the main products under life insurance. Retirement benefit is also part of life insurance, but we can cover that later. Over to you, Noella. Thank you.
Thank you, Pauline. And that was quite detailed. You spoke about the 2,000 that you quickly raise when you see someone has passed on, and being added onto WhatsApp groups to raise money. And we're going to come back to that. I know some time back we was talking about Operation Finish, those Maliza, those Garden Square kind of meetings, like that. Planning for the funeral becomes even more expensive than the premium that you would have paid to get the same amount of money. But I see we have a question from JM, and this is directed to Kiama. Does a personal accident insurance policy cover physical injuries, or it can cover internal injuries? Then the second question, can a PA policy cover accidental inhalation of poisonous gas or accidental food poisoning that may leave someone with internal injuries? That looks like somebody who must be having a cover or is in the business. Mr. Kiama, kindly.
Yeah, thank you for that question, JM. Unfortunately, the personal accident will not go to this length, basically because it requires for the accident to happen, there has to be some bit of violent, an indication of violence. So if we talk about, for example, you are walking and you fall, you fall and injure your leg, those are the kind of accidents that are covered. Or if you are whatever kind of activity you are undertaking, you will be covered if it is a physical injury. But the inhalation of gases, this will not be covered. The cover, as I need to mention, the cover has got 3 parts. It will be covered for maybe in the event of death, in the event of permanent disability, or in the event of a temporary disability. Temporary disability means you've not been able to attend your duties as usual. So that's the breakdown of the covers that you have. It also covers a bit of medical expenses, but to be only as a result of the accident that happened. So in a nutshell, it doesn't cover internal injuries. The injuries has to be physical. Thank you.
Thank you. And I see we have a hand raised. Aina N-Y-E-N-Y. I have a problem pronouncing that, but you can go. Good, you've known yourself.
Thank you,
Yes.
Noella.
Yes.
My name is Ainaini, but you can call me Aina. So thank you for the presentation, especially from, I think it's Pauline, because I've known something I didn't know about the endowment policy. I'm a former customer of an insurance product, and I had a very bad experience. And the reason I'm joining this call is because I wanted to understand what actually happens in this industry. So I'm coming at a place after buying a product, getting disappointed. I've gone to the highest levels that anyone can go, to the IRA. I've seen the CEO of that company. And what I've seen in this industry, well, at least from my experience, is that, yes, these are good products. I don't disagree with that. But the way they are sold, the process to which people get these products is not right. And I know there are organizations that create awareness, but as a marketer, because I also do marketing, content marketing, the reality is that the information you're trying to get across to the audience will not reach them. Because personally, I have never come across any information from ACI and all these other organizations that try to create awareness. And it's probably because you're not selling insurance. Before I get information on social media, the algorithm looks at the kind of things that I search for. So it will recommend to me other insurance products because that is what I'm looking for. It's not gonna recommend to me all this information from you people because you're not selling. That's why people are probably not getting this information. So I had an experience where someone sold me the wrong product and I've suffered because of it. I've lost money because of it. And I've also canceled the product and even because I had different products from that company. I had investment, I had bought the life policy. So I've canceled it just because of trust. And there's no way I can go because I signed the policy documents, even though the staff member that was explaining to me the product gave me the wrong information and basically offered me the wrong product. But there was nowhere I could go because I signed policy documents. I went to IRA, they didn't even respond to me. They never commented. So there's just nowhere a customer goes when there's misinformation, when they are hurt. What happens is that people are just disgruntled, you leave the product. Even right now, I cannot even buy insurance. Okay, of course, for the general ones, those ones like medical, whatever, those ones I can take. But for these long-term ones, there's just no security for a customer. Like the process to which you get a product, people can just misinform you as long as you sign those policy documents. At the end, they'll tell you, why didn't you read? As if I'm expecting the company to lie to me about the product that they're selling to me. So my thing is, I had a recommendation. Maybe you need to consult with marketers on how to share this information. And also, I think if you people were to come in and reach out to everyone who buys a policy in this country, like let it be a law that immediately, let's say a company like whichever, let me not mention that company's name, whoever they are, when they sell a policy, you are notified immediately and you reach out to this other person and tell them, by the way, these are the things you should consider. And these are the complaints we normally get. Make sure that these things you have looked into this. Once you are comfortable, go ahead. And because they usually give, I think, 1 month before the policy becomes permanent and all that. So unless there is that, I feel there is really no sincerity because you can be marketing, you're marketing, but you're marketing to people who are not even seeing you. They don't know about you. So that information that you're trying to get across is not reaching the right people. let me not take a lot of time, but that's what I had to share. I feel that what you're doing is good, but you need to reach the customer. When they buy a product, let them, you reach out to them, not the company, because these people have realized that the salesperson can misinform you and nothing happens. As long as you sign the policy documents, nothing is going to happen. I mean, you lose your money, nobody cares about you. But now
Okay,
you come
thank you. Aina,
Okay,
you have made your point, and I want
Okay.
to ask Galgalo from IRA to jump in. Of course, you are raising very pertinent issues in terms of how the insurance is sold, but I'm comforted in the fact that you still value insurance, because you have insurance for other things. You just have an issue and a problem with how to get back trust from what you purchased, and you say you are not taken care of well. I would like to invite Galgalo Kuche to come to on the call. Galgalo is works at IRA. He's in the Consumer Protection Department. Karibu sana Galgalo. And Galgalo, what should customers look for when purchasing insurance? You know, when they're considering to sign the forms, what should they look out for? Which are the questions that they may need to ask as consumers of insurance products? And how do they lodge complaints if they have to lodge a complaint, so that then the customer doesn't feel like, oh, they went to purchase insurance, it didn't work out, they're coming to IRA and the IRA is not doing much. So just tell us through all that. What should customers look out for when purchasing insurance? What should they be keen? And how do they lodge a complaint? Galgalo?
Okay, thank you, Madam Noela. And thank you, Ainaini, for that question. I hope I have pronounced your name correctly. Let me start with, I think the issues she raised on how the products are sold. We are aware, of course, insurance companies have marketers, they have agents who sell for them these products. And we have come across a number of cases where people are mis-selling products. And as a result of those issues, at some point we force insurance companies to they train their agents or their marketers on how these products are supposed to be sold, what information is supposed to be passed to the customer before onboarding these specific clients. To add on that, that is still not enough. For some time, we've been trying to deal with that, and we've come up with something called market conduct supervision. And market conduct supervision entails dealing with the behavior of the regulated entity. For example, if how they market this product, how they sell, and after selling, how do you treat your customer at the point of maturity or claim? All these things that we call it market conduct supervision. It is a new thing we've come up with, we are implementing now, and probably we might feel the fruits much later, not at this point, but it's a new concept we've come up with. So about how these insurance companies sell products to their clients, so far that's where we are, that's how we are dealing with it. And on consumer protection, we deal with case-by-case basis. And I'm happy Inaimi mentioned she reported a complaint to us, and I would like her to give us her details so that we look at that specific complaint, because she mentioned she never got any response from us. That one we deal with it at that point. On the other issue of how to launch a complaint, we have several avenues of launching a complaint. You can write a physical letter to us, detailing your complaint together with any evidence you have. You can also write to us an email. There's an email for reporting complaints specifically. It's called complaints@ira.go.ke. It is also on our website. And we have a complaint form also on the website where you can download. It will guide you on what to put or what the information to give us. From there, we pick the specific issues and deal with those specific cases. I think that's what how I can respond to that question, Madam Noela. Thank you.
Thank you. I have somebody saying insurance agents are out to hit sales targets. No client needs, they feels like a con. Mr. Kiama, this is such a hard statement for the industry that you represent and we represent. Is that the case? I know that Aki has been engaging on a number of initiatives with the insurers to ensure that the customers are taken good care of. Maybe you'd want to speak to the initiatives that Aki is rolling out or has put in place.
Yeah, thank you for that. Thank you for that question. And I think I just want to echo what Gargaro has talked about the market conduct. I think it is a new thing, and we expect to see results on this because basically we have had a number of errant agents who were doing all manner of things. But I think some steps have been taken, or some preventive measures have been taken. For example, we have been doing a lot of agents training. We've been trying to involve them, to involve the agents in how to sell these products and how to handle them. Problems comes, and I don't want to say that it is not there, that we have agents and sub-agents. So there you have those agents who are licensed, and you also have some other people masquerading as agents, but they are sub-agents of agents. So sometimes you may confuse the two. There are those who are well trained. There are those who have not been trained about the product. So sometimes they do a lot of misrepresentation that we totally agree. So we are trying to look at how best to handle this. But basically, I know the training that is happening jointly with IRA, I think that will help in terms of weeding out those agents. We also have the insurance fraud unit, which is under IRA. I know maybe Noela will be talking about it. They have also tried to do a lot in terms of weeding out these agents who trade without, they are not licensed to trade, but yet they are masquerading as insurance agents. All is not lost, so we expect a lot of improvement in terms of how the business is conducted. With the training, I believe we'll be able to achieve some milestone. Thank you. Over to you, Noela.
Thank you, Mr. Kiama. And while you are still at it, of course, we are aware that a lot has been done, and the industry being the very nature of it. I just want to ask, the other day I was in a clinic, an insurance clinic, because we conduct insurance clinics. We have Bima Mashinani programs across the country. We have activities targeting various people in the economy. We have trainings for HR people, because they're the ones who procure insurance for their employees. We have trainings for SMEs. We have one currently going on. Do consumers have a role to play? Somebody the other day asked me, when I go to the bank to purchase insurance, to take a loan from the bank, and the forms are long, what are my duties as a client? And I just want to hear from you, Mr. Kiama. Do clients have obligations? Insurers, of course, have obligations. They've got to educate the consumers, to make them understand what it is purchasing, what it is they're buying, what is excluded, what is included, how they stand to benefit, the process of benefit. They need to be told. What are the obligations of the consumers or the clients when purchasing insurance? Mr. Kiama?
Well, I think as just like you have talked about the banks, you need to clearly identify, you clearly identify your need, and then look at what kind of product addresses my needs. Then with the assistance of a technical person from now who understands insurance, then you are able to get the deep information relating to those products. We have seen cases where people maybe take a product and then just like Aina has said, you pick a product and then on the way you realize that you didn't pick the product that addresses your need. So it is important for us also not to be that ignorant, or agree to read a bit in terms of checking the product that we have. Looking at for example a general insurance product, you need to understand what is covered, so that then we don't come at the end of the day we are arguing that XYZ was written in black and white as excluded, and then I did not know that it is excluded. You also need, there's also something that we call the excess. Is this policy subject to an excess? And if it is subject to an excess, what amount, what does that translate to? So there are those key things that you need to pertinent things that you need to look at, so that then you understand whether the policy actually addresses your need. And unfortunately, as we mentioned, there are people there are some agents who will not go into detail of what is covered. And then when if a person is ignorant, then they are going to purchase that product, and at the end of the day, they will be complaining that this product does not really address their needs. So we need to look at several issues, even as we sit as members of the public out there. We need to look at, what am I being covered for? Is it the cover that I need? For example, you go for a health, for a medical insurance policy. You have you have probably a pre-existing condition like diabetes, like blood pressure, and then we say from the policy you'll find that this is actually excluded. Then that means you, if you didn't have that information and you are thinking you are getting cover basically for that, then you be starting from the wrong footing. So it is important for us also to just read a bit in summary what is covered under the policy. You'll find a number of companies giving a summary of what is covered. Also, some insurance brokers and some agents will give you a summary of what is covered in terms of what we normally refer to as a risk note. So they'll be giving the key highlights of what is covered. So it is important for us to ask for that summary of the cover, so that then we understand what is covered and what is not covered, so that we don't argue at the time of claim. Thank you.
Thank you. And we have quite some conversations. I think this is something that Aki and I might want to mull over. Joanne says, I like the suggestion by Aina on following up within a month of sale. Can this be made mandatory for insurers as part of treating customers fairly? That's, I think, I'm sure it's food for thought. Can a callback after a month be made mandatory? That, for instance, we know, Noella, in our records, you purchased insurance 1 month ago. Did you purchase this? Is this what you want? We see some other service providers doing that. Is that something that can be done? On the issue of Clinton is asking about actuarial graduates doing ECOP, and can they be given an exemption? We do not have ECOP running right now, Clinton, but actuarial graduates, Bachelor of Commerce graduates are exempted from COP. They are not expected to do that if they want to purchase insurance. I may say again, winning back trust is key, and please consider reaching out to every person as soon as they buy a policy and outline the common complaints you normally get and ask them to share their information. I think that's good feedback, tying up to the issue of doing the callbacks after 1 month. Jen says she's hearing about risk note summary for the first time. I would be interested to know, Jen, do you have an insurance policy? Do you have an insurance cover? Do you have your policy document, Jane? Because that would make us know whether you have the risk not or not? Kindly let us know, Jane, if you have an insurance cover, if you have a policy to the cover that you have. Mr. Kiama, you've spoken very well about the general insurance, but I would like to know what most people know and what most people interact with in terms of general insurance, of course, is motor insurance. And that's because it's compulsory. You are not going to be on the road if you don't have an insurance cover. And then, of course, we also have the comprehensive, we have the third party. Maybe you just talked a little bit on more in terms of the third party comprehensive. What's the difference? And we get complaints about somebody saying my car was on comprehensive cover, and then when I go to lodge this complaint, I'm told this was not covered. So how comprehensive is comprehensive cover? How comprehensive is the comprehensive cover? Talk about the excess and the third party, Mr. Kiama.
Yeah, thank you, Noela. I think I didn't mention about motor insurance because I was thinking probably most of us do understand it, and that was I think that was an omission from my end. One, as you have mentioned, we do have motor insurance third party only, which is a compulsory cover, and this will cover you against injury to other persons, not yourself now, is to other persons, and damage to their property. That is what that party cover will give you. So that means when you are on the road and you have a third party cover and you hit another person's car, means you have damaged their property. So your third party insurance will come in to compensate the other person that you have damaged their property. Likewise, if you injure them or you injure a pedestrian or a person in the other car, then your insurance should come in to compensate that other party. However, damage to your motor vehicle is not covered because you are on third party only. So if you have a comprehensive cover, it means that you have a cover now covering the other party's damage to the other person's property, that is damage to their vehicle, or injury to other persons like pedestrians or persons in the other car, and to also now cover your vehicle against accidental damage or theft. So if you're on the road and you have a comprehensive cover and then your vehicle is damaged and the other person's vehicle is damaged, your vehicle will be repaired by your insurer by virtue of being on comprehensive cover. The other person's vehicle will be repaired by the same insurer, basically because they have been hit by a person insured by the company X that is compensating to pay for your claim. So that is the main difference between the comprehensive and the third party. So with the comprehensive, any accidental damage to your vehicle will be paid by your insurer. Theft of that motor vehicle will be paid for by your insurer, and damage to other people's property or injury will be paid by the insurer. For third party, it is only injury to other persons or damage to the property of other persons that will be covered, but damage to your property is not covered. In summary, that's what I wanted to put across.
Thank you. Are the radio cassettes, the stereos, covered in the motor? Is the windscreen part of comprehensive? What about the mirrors? What about the wheels, the tires? Are those covered? And if you change the specifications of your car, you put in a big exhaust, you change the wheels, you lift up your car up. How does that work?
Yeah, for example, if you make any modification to your motor vehicle, provided it doesn't interfere with the stability of that motor vehicle, then the vehicle will continue to be on cover, unless, of course, the changes that you have made make the vehicle to change in terms of use or security of the vehicle. So if you make a number of adjustments, then unless there are major changes, then if you make major changes, you need to inform your insurer that I have done X, Y, and Z. For example, you had a vehicle that was which was 1500 cc. All of a sudden, you have replaced that engine, or even not a higher power engine, the same kind of power engine. Then you need to inform your insurer that I have changed my engine, and this is the new engine number that I have gotten. Likewise, you need to go to NTSA and have that change of the engine endorsed in the motor vehicle. You have changed a vehicle. You've changed a vehicle from being, for example, it was a station wagon. You have built in another body. You have made it to become a pickup. That is a major change that you then need to inform your insurer that I have done this change, and probably the use of the vehicle will also change how I have been using it. So insurers will normally base their premiums or the covers on the use of the motor vehicle. So you need to inform them when you make that kind of a major change. In terms of the radio cassettes, the windscreens, all those items are covered subject to some limit. For example, if you have a vehicle, you have a radio, we have a music player in it. Let me not say a radio cassette. Is a music player, most of what we have seen currently. It is also covered subject to a limit of, let's say in a private car is about 30,000. So if you need to be covered above that, then your insurer will be able to inform you the amount of premium that you will need to add for that radio music player to continue to be covered. Likewise, we have a free limit for windscreen. Windscreen would have, for example, like 50,000. That would be free when you have a comprehensive cover, but you have some of these expensive vehicles, then you find the windscreen going for 150,000. Then you need to inform when your insurer does the valuation of the motor vehicle, they will need to inform you the amount of money that you need to add, so that then your windscreen is fully covered. Why we have separate covers for those radio cassettes and windscreen, in the event of an accident, the music player is stolen or the windscreen is cracked and there is no other damage to the motor vehicle, then you don't need to pay what we call the policy excess for you to be covered. The policy excess, I can briefly just state, is an amount of money that you pay for every claim that you lodge. For example, if you have a motor vehicle which is insured at 500,000, then your insurer will be telling you you have a percentage of 2.5. Right? It's normally 2.5% for a private vehicle. So that works for a 500,000 vehicle. That works to about 10,000. So your insurer will expect you to pay the first 10,000 for your claim to be paid. So if you have a windscreen cover, the windscreen cover, the free cover that we are talking about now for the windscreen, that one you do not have to pay for the excess. Likewise, for the music player, then you don't have to pay for the excess for that claim to be admitted. I am not sure whether I have talked about so many things within the short time that we have, but I hope I have tried to explain the third party and the comprehensive, and also the what we mean by the policy excess. It is an amount of money that you will need to pay for every claim before every claim is admitted. In other words, you are also made part of the insurance company. For example, if your excess is 2.5%, it means you are insuring 2.5% of the vehicle, and the company is insuring 97.5%. So for every accident that happened, you are responsible for the 2.5%. And that is why you'll find if a claim is below the excess, then you are told to go and repair your motor vehicle, because that amount comes before the insurer comes to pay the claim. The amount that you're supposed to pay comes before. Thank you.
Thank you, Mr. Kiama. I have a question. I'll ask Galgalo Kushe to come on board. Somebody is asking, do we have, what is the insurance standard number of days to report an accident to the police? How many days do you have for a consumer or customer to report if an accident has happened to the police? In the same note, the person is asking, we also have a question in terms of what happens to customers with active premiums and the insurance company closes the company. I would imagine IRA closes the company. How does IRA help? I mean, what happens to customers with active premiums and the insurance company closes the company? How does IRA help? What happens when a company closes shop? What is the way forward for those with life or long-term covers and for those with short-term covers? Galgaro, kindly.
Thank you, Madam Noella. On the number of days to report an incident to police, if it's an accident, normally it's supposed to be done within 24 hours. That is standard. But it depends on what kind of incident you are reporting. If, for example, it's a theft, for that matter, it is reported within a reasonable time. Reasonable time means if, for example, you are the one who is mugged and something is stolen, and the reason why you are reporting is not because of the injury, it's because of the items that are stolen. Probably you need to go and have an insurance claim. It depends on when you get to a position where you can report, or even an injury claim for that matter. If an accident occurs, maybe the incident was reported, an accident was reported, but you as the injured person, the reasonable time within which you are required to report is when you are well enough to go and report to the police and maybe do a statement. But ideally, it should be reported within 24 hours for you to report to a police station. But to the insurance company, it varies from company to company. It also depends on the kind of policy you have. Most general insurance policies, you are supposed to report within 7 days. Should be done immediately or as soon as possible, but not later than 7 days. If you do it later than 7 days, you must give a valid reason as to why you are reporting late. And you have a valid reason, it's good enough for the insurance company to pick up the matter and process the claim. And on the issue of closed company, once IRA put a company under statutory management, it's handed over to another body called Policyholders Compensation Fund. Policyholders Compensation Fund will compensate claims that are payable or policies that are payable, and also give guidance on the issues of continuing policies, for example, medical policies, because once you pay an annual premium, it's an ongoing thing. You can go for medication at any one point, if it is a corporate or even an individual policy. So that information can be given by PCF, Policyholders Compensation Fund, on what will happen to the other policyholders who have paid premiums. Their policies are not have not matured, or they have not lapsed. I think that information can be gotten from Policyholders Compensation Fund. I don't have the specific answer to it right now. Madam Noella, back to you.
Thank you, Galgalo. I think in our next webinar, we're definitely going to include policyholders so that they're able to address those issues. I want to ask Pauline. The other day I was in a clinic again, an insurance clinic out of Nairobi, and we met these teachers who were telling me that in fact they came to complain that they were being taxed pay as you earn, and yet they had purchased insurance. And I think they were told when they purchase insurance, then they're not going to pay tax because there's the insurance relief. And so I asked the teachers, if you don't pay tax, how are you going to earn a salary? Where's your salary going to come from? Because it is this that somehow that ends up the monies that are collected that comes to you, because that is how you're paid. But maybe you could just speak to the matter of insurance relief. In the case of long-term insurance, how does that work? What is the motivation, and what is the process for someone who is purchased insurance to just get to have the certificate? Pauline?
Thank you so much, Noella. Yeah, that's a very good question. The Income Tax Act, there's a provision that the government has given a provision for tax relief or insurance relief for anybody who purchases a life insurance policy. And the tax relief is 15% of the premium that you're paying, subject to a maximum of 5,000 per month. So in a year, it works out to 60,000 as tax-free. And this is a very good benefit, especially in this era, of taxation. So how does it work? It works two ways. One, and which is the easiest, is that what we've done at ACI, we engaged KRA, and we have a recognized tax certificate that actually we've come up with a portal which is online. So what happens is, once you purchase a life insurance policy, the insurance company automatically is able to prepare and download your policy, your tax relief certificate. Now, these tax relief certificates, you can apply it in two ways. Number one, you present it to your employer. In this case of the teachers, to TSC. And the person preparing the payroll, if it's finance or it's HR, then they are able to give you tax relief at the payroll stage. So that now when they are calculating your salary and calculating the tax you're supposed to pay, you're automatically given tax relief. And you have that tax relief certificate that has been issued by your company, but it bears the logo of ACI, sorry. And when you present that to the person preparing the payroll, then they are able to extend that relief in your payslip. So you enjoy the tax at that stage. The other way of enjoying that tax, unfortunately, there are some employers who may not be able. You need to talk to your employer, because that's the easiest thing, to extend that tax relief when they're preparing the payroll. But if that is not done, you still have the tax certificate. So when you're doing your annual tax returns, you then you attach the tax relief certificate, and KRA then is supposed to give you a refund of the tax relief that you did not enjoy at the payroll stage. So it's something very easy. The tax relief certificates are available. It's an online portal we have. And once you buy, it's automatically issued to you real time. You don't need to wait for a number of days. So those are the two main ways, Noella. And for the teachers, I would really urge if they could engage their employer, and if TSC is able to give them that tax relief at the payroll stage, that would work the best for them, and the tax certificates are available.
Thank you, Pauline. And while at it, the other day we saw a lot of media and a lot of disinformation about the tax. There's talk about tax being put on insurance, on insurance, and talk of already we are having a challenge. Can if the compensation is taxed, and so much going on. Is it possible for you just to unpack this in basics? What really were the discussions? At which point is the tax? What is to be taxed? If at all the tax is to happen, really, what is it?
Thank you so much, Noella. Yeah, the finance bill, now the Finance Act, created a lot of havoc for many people because most of the things that were contained in the bill, we were not so sure how they were going to impact us. Now, on this issue, where there was the assumption that insurance payouts will be taxed, it was contained in the finance bill. And the way it was contained, actually, there was no mention of insurance payout. It was any service where somebody receives money is supposed to be subjected to VAT and tax and taxed at, I think, at the VAT rate. So the assumption, if you read the law, would be that even an insurance payout, in the case of this would only touch on general insurance companies, not on life. So what I would say is that the law is not very clear. You could very easily find KRA now implementing that and saying that an insurance payment for loss of goods where you're being compensated is now subjected to VAT. But the law has not come out very openly to mention insurance, but it is an implied service that could attract the VAT. Okay, it would not touch on life insurance payments, but definitely it would touch on payments regarding especially property insurance. So given that it's not very clear, what happened is we had an engagement with the Finance Committee of Parliament, and they came out clearly to say when they came up with the law, they didn't have insurance in mind. So we are waiting to see how it will be implemented, so that if it touches on insurance payouts, that would definitely be going even against the very principles of insurance, the principle of indemnity, where you're supposed to be compensated and put at the same level you were before the incident. So I think we will watch and see how it's implemented, because insurance was not explicitly mentioned. And the response we had from the Finance Committee was that when they came up with it, they didn't have insurance in mind. So we will wait, Noella, and see how it's implemented by the government.
Thank you. I'm sure you've answered Francisca. She was asking, kindly expound on the 16% payment after maturity. Is it on life insurance or general insurance? I'm sure you have spoken to that. I want to ask anybody with a question if they would want to raise their hands before I ask my questions. Any person on the line with a question, or they would rather type it or raise their hands before I ask my question. So, well, as we're waiting for that, Mr. Kiama, back to you again. When I sell my car, do I sell plus insurance? Actually, last week I got a call, Mr. Kiama, and it's an interesting one, in the sense that this caller has a car in his name, and the caller and the wife, I think they had a disagreement, and so they have separated. But the wife is using the car. Of course, the cover is in the man's name. Is in the man's name, so the insurance is getting out in the man's name, and so the man would like to change or to stop the insurer from issuing the cover in his name because he is not using the car. And so was asking, what is the process? The lady has the car. He wants to stop the car being insured in his name because he doesn't have the car. The car logbook is in his name. How does that work? How would they do that?
Thank you for that question. I think is a bit of a technical question there, because some of these matters you may not quite be able to determine, because it is the court's duty to just have a look at, are these people still married, and can they be referred to as owners of the property, or how will the property be divided? But nevertheless, let me say this: insurance is normally a personal contract. It cannot be transferred to another person. So the question that will come through is are these two people, or is it still the one person? When people get married, we are told they become one. So as to whether they can use this insurance anyhow, either of them, I believe that is something to be determined by a court of law. But legally, unless there has been that divorce, then since the vehicle is still in the name of the man, that is the person who is insured, does not mean is the only person who is authorized to drive the motor vehicle. Anybody, as long as they are driving with your permission, then the cover still operates, as long as they're driving with the permission of the insured. But transferring of an insurance contract, you cannot transfer it to anybody else. What you can do when you sell your vehicle is that you need to cancel your insurance cover, so that then that new person now takes on their own insurance. It takes a bit of time to have that motor vehicle transferred to your name, and whether the logbook is your name, as long as you are able to show that you have some insurable interest, you are the owner of the motor vehicle by virtue of having a sales agreement, then the insurer will be able to give you a cover for some time until you're able to transfer the motor vehicle. Even in the proposal form, you'll find the insurer asking in which name is the vehicle registered, so as to know whether it is in your name or in another person's name. But they'll give you a bit of time so that you're able to transfer the motor vehicle, but you cannot then sell a motor vehicle and claim to sell with insurance. The best thing is, once you sell, you cancel your vehicle, you cancel your insurance, get a refund, because you are entitled to some refund when you cancel your policy. Let the new owner take their own insurance policy. Thank you.
Thank you. And actually, I was going to ask what happens to when you sell and you cancel. What happens to your to the premium if you had paid for 12 months and you are giving it out in 3 months, and you've spoken to them the matter of getting the refund from the company, so that then it takes to the other side. And thank you so much about that. Still on you, Mr. Kiama, medical insurance is one of the things, it's one of the most selling classes of general business. Waiting period. Why should there be a waiting period? How the insurers, when you've had a cesarean for the first time, when you're having the second cesarean, they tell you they might not insure your second cesarean operation and third. Why is that so? And yet it's a medical issue.
Okay, starting with the waiting period. The waiting period is normally a period that you do not get the medical insurance service. You have paid for your medical insurance, but you cannot get the service from any quarter for some time. There are people who give like 30 days. And this is basically because to avoid selection. By selection, I mean those people who know they are sick and they are likely to be admitted, or they are being admitted, they know they are being admitted tomorrow or the next day. They are likely to go on and take on an insurance cover for purposes of, because they have that background information. So if the insurer was to take everybody on board without the waiting period, the premium then would be very high because of those kind of incidences. For persons who know next week I'm going in for an admission, so I want to take in a cover, and then after I take in the cover, then I am admitted using that cover. So if that were to happen, then the premium rates would be very high. So what the insurer does to maintain to maintain the premiums to some lower level is to give that waiting period, so that not only the sick or not only those people who know they are going to the hospital who will come in to take the cover, but it's anybody who is a person who is actually looking for that cover, but it's not a person who is coming to pick it just for purposes of utilizing it for that. In other words, what we were talking about, the excess in a motor policy, where you're supposed to be your own insurer of some kind of percentage. It is the same thing. It is it operates like the excess. So you're not going to, if you are admitted within that period, you are not going to be, your claim is not going to be admissible. We also have what we call time excess in other classes of insurance, where you have like consequential loss. If you are claiming for a consequential loss, then which is I'm not sure I need to go there because it's a bit technical. You are given a time within which consequential loss you claim. For example, if a building is burnt and you are not able to operate, then you can, if you have a consequential loss policy, you are able to claim for the salaries that you will pay. You are able to claim for the profit that you would be making for the time that you are not operating. Now, those policies are subject to a time excess. So it is similar, the waiting period is similar to that time excess. You're not able to access services for that period. In terms of cesarean, you'll find most of the policies covering the first cesarean and not the second and the third, because they will definitely, if, for example, is normally referred as an emergency. The first cesarean is normally referred to as an emergency, but when you're now aware that childbearing from your perspective is not going to be normal, is going to be through cesarean all through, then that is a risk that they term as not being an emergency, and that is why they basically exclude that. The first cesarean is covered. It is normally covered because it is not something that you are aware of, and you do not have the information that your childbearing is through cesarean. So that is why they normally exclude. Now, if they were to cover cesarean section for persons who know that is the process they will be going through every now and then that would have a very big effect on the premiums. And that is why they normally exclude that, so that then that portion is not costed in terms of the premium. But if they were to cover that, then that means they would have to increase the premium that they are charging. Thank you.
Thank you, Mr. Kiama. And as we draw to a close, I would like to ask Pauline. She's our life expert here. This is a question from Francisca. What happens if I have an investment of 8 years and on the 5th year, I lose my job and can't afford to pay the premium? What happens to my policy? Can I withdraw in the 5th year, or have I to wait until the 8th year? Pauline, as you are addressing this, kindly also speak. We get a lot of queries on issues of surrender, the surrender value, the issues of paid up policies, the issues of how and which is the best time to get out. And if I get out, I've paid for 4 years. Each month I was paying 4,000. So I need 48,000 times 4 years, Kindly, if you would speak to that, I'm sure you'd answer Francisca and many others who are on the call. Thank you, Pauline.
Thank you. Thank you so much. Yeah, that's a very good question. Maybe what I need to first just go through is that a life policy has both the protection and the investment side of the policy. So like even what we are talking about, the investment product for 8 years, it has some part of it as the protection cover. And the premium that somebody is paying is divided between those two. There's a portion that goes to the investment, a portion that goes to the protection. Now, if we look at the protection side, somebody could just be paying 5,000 per month as the total premium. But what happens is that that whole money does not go into the investment, and the insurance starts from the very first day. So if that person was to unfortunately pass away or get, like what we talked about, critical illness or even permanent health, permanent disability, you'll find that even if they've just paid one premium of 5,000 and the sum assured is 1 million, the insurance company will come in and pay the 1 million because that is what the policy provides. So I think one of the main confusion that happens is that people forget their policy has a protection cover and also an investment cover. So even if I am paying 5,000 and I've paid for 5 years and then I want to withdraw, I should not count that I have paid 5,000 every month times 5 years, because part of that premium was going to my protection. And for many people, if an incident had occurred, the insurance company would have paid the full sum assured that is outlined in the policy document. Now, for this case of Francisca, it's good, we would need to see the policy so that we know what the policy conditions were. But basically, the costing of this policy and the premium she's paying per month were based on the policy condition or terms of an 8-year policy. So if now the 5th year and unfortunately somebody loses a job, that is very prevalent in our Kenya today, and they can't afford to pay the premiums anymore. The first thing I would advise somebody to do is engage with your insurance company so that you learn the options that are open to you. We have options like where an insurance company can actually work with you to reduce the promised benefits. So if maybe the total sum assured or the maturity amount was supposed to be 2 million, you can work with the insurance company for those benefits to be reduced, or even for the period of the cover to be reduced, depending on the policy terms of that policy. Another option is also to have a surrender amount to surrender the policy, and you're paid a surrender value, which of course is less than the total value that you'd have been paid if the policy went on up to 8 years. Another option could be what we call, Madam Noella just talked about, the paid up premiums, where the company can extend a soft loan to the policy, and that loan is used to pay off the premiums for the period somebody is maybe stabilizing financially, to ensure that that policy remains in force and does not lapse. So there are all those options, and I always say the best thing is to engage with the insurance company directly, not necessarily through the intermediary, so that you sit down and understand what your options are and explain to them what the problem is. I know that for endowment period, for most companies, that there's a period of 3 years, or for some companies 2 years, where if somebody doesn't pay up the premium within that period, then the policy lapses without any surrender amount. Yeah, so it's always good when somebody is buying for them to keep that in mind, read the policy, understand what the conditions are, where you're not aware, because I know now, and I know IRA have done a lot of work on this, especially on simplifying the policy document so that the language is simple. Please read. Where you don't understand, reach out to to your company, not necessarily through the intermediary. You have the numbers of your company. You can ask for a clarification. Reach out to us on our website. If you visit the ACI website, if you visit the IRA website, there's a lot of information on those websites that can help you understand better what the policy provisions are. We have that information. We have guidebooks and booklets on our website you can read. And where you don't understand, we would be very happy if somebody could reach out for more information. So Madam Noella, basically those are the options. So the best thing is to reach out to the company so that they understand and work out the option that works best for them.
Thank you, Pauline. And I think with that, I would like for us to end this session. It has been very enlightening, and thank you for coming on board, Pauline. Thank you, Kiama, for coming on board. And thank you, Galgalo, for standing in for Monica, who seems not to have made it to this call. We want to confirm that we have all the issues raised, and we are going to get back to those who have raised them. Ainea, kindly speak to us behind the tent. We'll be liking to talk to you. And this has been recorded live on Facebook, our Facebook page. You can always stream and share it. Until then, see you in our next session and have a good afternoon. Thank you so much.